Everyone remembers 2022. Luna collapsing, Celsius going under, FTX imploding, billions vanished. Confidence shattered. People said that was the bottom. But what if it wasn't? What if it was just the rehearsal? Because right now, behind the optimism, the ETF hype, and all the talk of a new bull run, the same dangerous patterns that led to that collapse are starting to reappear. And this time, they're bigger, more interconnected and far more systematic. Welcome back to the channel. If you're new here, I'm Paula, and this is where we talk about what's really happening in crypto, the economy, and the systems shaping both. Not hype, not hopium, truth. Because the more you understand the game, the less likely you are to become somebody else's exit liquidity. So let's dive into what's quietly building beneath the surface and why I think this next collapse could make 2022 look like a warm-up act. Everything feels stable right now. Bitcoin's hovering, altcoins are recovering, institutions are coming back, and even the media is cautiously positive. But here's the paradox. Collapses never happen when things look chaotic. They happen when things look safe, when confidence returns, and when people stop questioning risk. And confidence right now is sky high. Leverage is creeping back into the system, stablecoin supply is inflating again, and retail traders, the ones who swore they'd never touch crypto again, are slowly drifting back in. That's exactly what happened in early 2022. The market lulled everyone into a false sense of security, and when the first domino fell, the chain reaction was unstoppable. Let's rewind for a second. In 2022, the entire house of cards started with over-leverage. Projects promised 20% yields, unbacked assets were rehypothecated, and institutions like FTX pretended to be solvent while printing their own collateral. When Terra collapsed, it triggered liquidations across the board. Funds that were exposed had to dump Bitcoin to cover positions, sending the whole whale market into a spiral. Celsius froze withdrawals, Voyager collapsed, BlockFi followed, then the ultimate betrayal, FTX. The exchange that was supposed to save everyone went down. It wasn't bad luck, it was design. The system was built on circular leverage, fake transparency, and a belief that this time is different. Sound familiar? Fast forward to now. The names have changed, but the patterns haven't. Back then, the lie was we're decentralized and safe. Now the lie is we're institutional and regulated. Everyone's cheering that traditional finance has arrived. BlackRock, Fidelity, VanEck. And yes, it gives crypto legitimacy, but it also concentrates risk. When the same few custodians, issuers, and liquidity providers control most of the assets, a single failure becomes systematic. We've traded one form of fragility for another. Take stablecoins. They're the invisible backbone of crypto, the thing that keeps liquidity flowing. But here's the uncomfortable truth. They're only as stable as the assets backing them. When markets tighten, those reserves get tested. If a major issuer like Tether or USDC ever faced redemption pressure during a liquidity crunch, it could cascade everything across the exchange. Remember, when Luna's algorithmic stablecoin failed, it wiped out tens of billions in market value in days. Now imagine that, but with hundreds of billions tied to global trading pairs, and no one's really stress tested that scenario yet. Look at derivatives. Open interest is climbing again to near 2021 levels. Perpetual futures are heavily skewed long. Funding rates are positive across most exchanges. In simple terms, traders are borrowing to bet on higher prices. That's not confidence. That's fuel for liquidation. When everyone's on the same side of the trade, one sharp move can cascade through the system and liquidate billions. I've seen it before. A single big sell order can trigger margin calls, stop losses, and panic selling. And when the first candle drops, the algorithms take over. That's when a correction turns into a crash. Right now, people feel safer because institutions are here, because we've got EFTs, clearer regulation, and big names attached to crypto projects. But that safety is an illusion. When institutions enter a market, they don't remove risk, they move it. They shift it onto shoulders of retail investors, smaller funds, and anyone who doesn't understand how the plumbing works. When a bank or EFT loses money, they rebalance, hedge, or sell off exposure. When retail loses money, they lose everything. And while institutions might not cause the next crash directly, their exit from risk assets could easily trigger it. Because if equities wobble, if interest rates rise again, or if liquidity dries up, crypto will be the first thing they dump. In 2022, the market collapsed because liquidity vanished. Now the same risk is back, but bigger. Stablecoin issuance has exploded again, yet actual cash backing hasn't grown at the same rate. DeFi TVL is rising, but most of that value is recycled collateral, and exchanges, despite saying they've improved transparency, still control the majority of trading pairs. One shock, a regulatory headline, a stablecoin freeze, a major hack could send liquidity evaporating in hours. When liquidity disappears, price discovery breaks, and that's when crashes go vertical. Then there's regulation. Governments around the world are preparing frameworks to control digital assets. In the US, Europe, and the UK, new laws will redefine what counts as a security, what counts as a commodity, and who gets to trade. That might sound positive, but short term it creates chaos. Because as these rules tighten, exchanges will delist tokens, funds will be forced to rebalance, and liquidity will fragment again. We've already seen it in small doses. Coins quietly disappearing from platforms overnight because they no longer meet compliance standards. Imagine that multiplied by hundreds. This isn't just a market story, it's a restructuring, and restructurings are never painless. Every cycle has a moment when people start believing they're invincible, and that's where we are now. Social media is filled with traders showing profits again, influencers declaring the start of a new super cycle, and analysts drawing parabolic lines to 200k Bitcoin. But optimism isn't analysis. Euphoria is just another form of leverage. It binds you to risk, it makes you hold longer, buy higher, and ignore the warning signs. And when the tide turns, it's always retail left holding the bag. So what could trigger the collapse? No one can predict the exact spark, but the dry tinder is everywhere. It could be stablecoin depeg, it could be an EFT scandal or custody hack, it could be a liquidity shock from traditional finance, a stock market correction that drains crypto liquidity overnight. It could be internal, an exchange failure that freezes billions in assets. Whatever it is, the pattern will be the same. First denial, then confusion, then the rush for exits. And just like 2022, most people won't realise it's happening until it's too late. But why could this time be worse? In 2022, crypto collapsed within its own bubble. Traditional markets barely flinched. But now with EFTs and institutional exposure, crypto is tied directly into global financial plumbing. If crypto collapses now, the shockwaves won't stay here. They'll ripple through pension funds, hedge funds, and even banks. That's why I say it could be worse. Because it's no longer isolated, it's connected. And the more connected something becomes, the more dangerous contagion gets. Here's the thing though, collapse isn't the end. It's the purge that clears the excess. Every crash washes out the scams, the fake volume, the over leverage, and what's left afterwards is cleaner, stronger, and far more real. So if or when the next collapse comes, the question isn't how do I avoid it? Because those who understand liquidity, who manage emotion, who build during the bloodbath, they're the ones who thrive in the next cycle. This isn't doom, it's preparation, it's awareness. So how do you protect yourself? Start by reducing exposure to things you don't understand. If you can't explain how a yield is generated, it's probably unsustainable. Keep part of your portfolio in self-custodied assets, and if it's not your keys, it's not your crypto. That rule hasn't changed. Watch funding rates, open interest, and stablecoin supply. When they spike, risk is high. When they drop, opportunity returns. And most importantly, stay emotionally detached. Don't chase green candles. Don't panic at red ones. Whales manipulate emotion. Discipline is your only defense. Every major transition in finance has gone through cycles of euphoria and collapse. This one's no different. Crypto isn't dying, it's evolving, but evolution always comes with extinction events. What we're witnessing is a separation between narrative and reality. The projects, exchanges, and tokens that survive the next collapse will become the foundation of the next era. The rest will fade into white papers and broken promises. Maybe this time really is different. Maybe the system has matured enough to absorb the shocks. But if history's any guide, overconfidence is always punished. The smartest thing you can do right now isn't to predict the exact bottom or top. It's to understand where you stand in the game. Because when the music stops, you want to be holding a chair, not a chart full of green lines that turned red overnight. If you found this breakdown useful, subscribe to the channel, share it with someone who's getting too confident right now, and drop your thoughts in the comments. What do you think will trigger the next collapse? And if you want to go deeper to actually analyze the data and prepare together, come join the Crypto Wolfpack. It's where we track on-chain movements, decode market psychology, and help each other navigate chaos with clarity. The link's in the description. Until next time, stay sharp, stay grounded, and remember, survival isn't luck, it's awareness. Thank you so much for watching, and I will see you in the next one.